April 13th, 1989, 9:47 a.m. Phoenix, Arizona. Federal regulators walk into Lincoln Savings and Loan headquarters. Not a routine inspection, a seizure. They carry boxes, court orders, lists of assets to freeze. Charles Keating, chairman, millionaire, philanthropist, watches from his office window. 15 years building an empire, vanishing in one morning. The numbers? Staggering. $3.4 billion in losses. Biggest savings and loan failure in American history at that time. 23,000 investors, most of them elderly, lost $285 million in life savings. But here's what makes this different from every other banking scandal. These weren't Wall Street investors, weren't hedge fund millionaires, were grandmothers, retirees, people who walked into their neighborhood savings and loan institution they trusted for decades and got sold worthless bonds by people they knew. One question haunts this story. How did a respected businessman convince thousands of elderly Americans to gamble their life savings on his real estate dreams? And why did 5 United States senators help him do it? This is the Lincoln Savings collapse. This is the Keating Five scandal. This is the story of how American deregulation, political corruption, and pure greed destroyed the retirement security of an entire generation. But this isn't just 1980s history. If you have savings in any bank or credit union, money in government-insured accounts, memories of the Reagan-era deregulation, this pattern cost taxpayers $160 billion in S&L bailouts, the biggest financial scandal in American history until 2008. Most of that? Your tax dollars, paying for someone else's fraud. Let me show you how it happened and the warning signs people missed when their friendly neighborhood banker started selling junk bonds. But first, understand the pattern. This wasn't the first time, won't be the last. There's a pattern that repeats whenever regulation gets stripped away and politically connected businessmen get too much power. Stage 1, deregulation, rules removed, limits lifted, oversight eliminated. Stage 2, aggressive growth, rapid expansion into risky ventures using other people's money. Stage 3, political protection, cultivate powerful friends, make donations, silence critics. Stage 4, desperation, losses mount, double down on bad bets, hide problems. Stage 5, collapse, house of cards falls, taxpayers pay, ordinary people lose everything. Continental Illinois Bank followed this in 1984, $7.5 billion bailout. Silverado Savings followed this in 1988, $1.3 billion lost. Neil Bush, president's son on the board. Madison Guaranty followed this in 1989. Whitewater scandal, political connections at highest level, same pattern, different names. Same result. In 1984, Charles Keating bought Lincoln Savings and Loan. By 1989, he'd reached stage 5. Let me show you how each stage unfolded and who paid the price. To understand how Charles Keating destroyed Lincoln Savings, you need to understand what savings and loans were supposed to do. Think back to 1950s, 60s, 70s. Your local S&L, the place where you opened your first savings account, where you got your home mortgage, institution that knew your family. Savings and loans had one simple job: take deposits from savers, pay them interest, lend money for home mortgages, earn slightly higher interest, pocket the difference. Boring, safe, predictable, and heavily regulated. Federal rules limited how much interest S&Ls could pay depositors, limited what they could invest in, required them to keep most money in home mortgages, safe, local, long-term loans. If you remember the 1970s, you remember why this system started cracking. Inflation hit double digits. 1979, 13%. People could earn higher interest in money market funds than S&Ls were allowed to pay. Depositors pulled money out. S&Ls started failing. Congress and President Reagan had a solution. Deregulation, 1980. Depository Institutions Deregulation Act lifted interest rate limits, let S&Ls compete. 1982, Garn-St. Germain Act. This was the big one. Let S&Ls invest in commercial real estate, junk bonds, business loans, anything. Removed the limits that kept them safe. Theory? Competition and freedom would make S&Ls stronger. Reality? Opened the door for people like Charles Keating. Now, who was Charles Keating? Born 1923, Cincinnati, Navy pilot, World War II, lawyer, successful businessman. By 1960s, ran American Continental Corporation, real estate development company. By all appearances, respectable, wealthy, donated millions to Mother Teresa, built hospitals, supported anti-pornography campaigns. Had powerful friends in both parties. In 1984, American Continental bought Lincoln Savings and Loan, small California S&L, $5 million purchase price. Why did real estate developer want a savings and loan? Because after Garn-St. Germain, S&Ls became money machines. Here's how it worked. Federal Deposit Insurance Corporation, FDIC, insured deposits up to $100,000 per account. Government guarantee. Your money completely safe, even if institution failed. This created what economists call moral hazard. S and L owners could take enormous risks with depositors' money. If bets paid off, they kept profits. If bets failed, FDIC paid depositors back. Heads, they win. Tails, taxpayers lose. Keating saw this immediately. Bought Lincoln Savings for $5 million. Within months, shifted from safe home mortgages to risky commercial real estate and junk bonds. Used depositors' money, your neighbor's savings, to fund his development projects in Arizona. Bought land. Built hotels. Speculated on raw desert acreage. Made himself loans from Lincoln Savings to buy more land for American Continental. Loans that would never be repaid. By 1986, Lincoln Savings had $2 billion in assets. Most of it, high-risk junk bonds and real estate. Keating controlled. Federal regulators noticed. Started asking questions, found problems, recommended seizure. But Keating had learned something important in American politics. Regulators could be managed. If you knew the right senators, this is where the pattern enters stage 3, political protection. The first temptation came in 1985. 1 year after buying Lincoln Savings, Federal Home Loan Bank Board, agency overseeing S&Ls, sent examiners to Lincoln. Routine check. What they found? Not routine. Lincoln had shifted from safe home mortgages to speculative investments. Violation of direct investment rules. Examiner William Black, he'd later become a famous whistleblower, recommended restrictions. Keating had a choice. Sell the risky investments, return to safe lending, follow the rules, or fight. He fought. Called his lawyers, called his accountants, most importantly, called his friends in Washington. This was the moment, the fork in road. Turn back, stay legitimate businessman. Push forward, become criminal. Keating pushed forward. His weapon? Political donations, lots of them. Between 1984 and 1988, Charles Keating and his associates gave $1.3 million to politicians. That's 1980s dollars, equivalent to $3 million today. The biggest recipients? 5 senators, who'd later become known as the Keating Five. Senator Alan Cranston, California, Democrat, received $120,000. His voter registration drives got another $850,000 from Keating. Senator Dennis DeConcini, Arizona, Democrat, received $55,000. Senator John Glenn, Ohio, Democrat, the astronaut, American hero, received $234,000. Senator John McCain, Arizona, Republican, received $112,000. His family took 9 trips on Keating's private jet, vacations at Keating's Bahamas home. Senator Donald Regal, Michigan, Democrat, received $78,000. Notice something? 3 Democrats, 2 Republicans. Keating bought both sides. Now, political donations weren't illegal. Politicians take money all the time. But what Keating bought with those donations? That crossed the line. April 2nd, 1987, 2 years after first examination. Lincoln Savings under investigation by San Francisco Federal Home Loan Bank. Keating called his 5 senators, asked for meeting with Edwin Gray, chairman of Federal Home Loan Bank Board, the man whose agency was investigating Lincoln. April 9th, 1987, 6 p.m., Senator DeConcini's office, Capitol Hill. Present, all 5 senators, Edwin Gray, Federal Home Loan Bank Board staff. What happened in that room would later be reconstructed in congressional hearings. Here's what we know from testimony and notes. The senators pushed hard, asked why Lincoln was being treated unfairly, why investigation taking so long, whether Gray's agency had vendetta against Keating. Gray tried explaining. Lincoln was violating direct investment limits, taking excessive risks. Regulators were doing their job. Senator DeConcini, according to Gray's sworn testimony, asked, "Why wouldn't these people be put out of business?" Translation, "Why are you trying to shut down my donor's company?" Senator Cranston pressed for timeline. When would investigation end? Senator Glenn questioned whether Lincoln really violated rules or just disagreed with interpretations. For 1 hour, 5 United States senators, men elected to protect public interest, grilled federal regulator on behalf of one banker who'd given them money. Gray later testified he felt intimidated, pressured, but he didn't back down. The examination continued. In September 1987, examiners William Black and Michael Patriarca recommended Lincoln be seized immediately, found extensive violations. And a recommended criminal referral. Keating fought back, again. This time, got San Francisco examiners removed from case, replaced with Washington, D.C. office examiners. Hired former Federal Home Loan Bank board member as consultant. Man who'd help write the deregulation rules. Used political pressure to delay. Meanwhile, Lincoln Savings kept operating, kept taking deposits, kept selling bonds. But now, desperate. Entering stage 2, aggressive growth to cover losses. By 1988, Lincoln's junk bond portfolio was losing money. Commercial real estate ventures weren't paying off. Keating needed cash, fast. His solution? Sell bonds directly to depositors, not government-insured deposits. corporate bonds issued by American Continental Corporation, Keating's real estate company, completely uninsured, high risk. Lincoln employees, tellers, branch managers, people grandma trusted, started pushing American Continental bonds on elderly depositors. Here's how it worked. You walk into Lincoln Savings Branch, want to renew your certificate of deposit, safe, FDIC-insured. Friendly teller says, I have better option, higher interest rate, issued by our parent company, very safe. Shows you American Continental Corporation bond, paying 9.2% interest. Your CD only paying 6%. What teller doesn't say. Bond is not FDIC insured. If American Continental fails, you lose everything. Bond is subordinated debt. You get paid last if the company collapses. Most importantly, American Continental is Keating's failing real estate empire. You're not investing in savings and loan. Your funding is desperate land speculation. Teller doesn't say this because teller doesn't know. Or does know but needs to make sales quota. Or knows but gets paid commission on bond sales. 23,000 people, mostly elderly, mostly small investors, bought $285 million of these bonds. Let's do the math on this fraud. Average investor, about $12,000 each. Typical age, 60 to 85. Typical income, Social Security plus small pension. What 12,000 meant? Everything saved from 40 years working. For Keating, commission fees. Cash to fund more land deals. Time to hide losses. Remember, these people walked into federally insured savings and loan, building they'd trusted for decades, dealt with people they knew, government seal on the door. They weren't buying junk bonds from some stockbroker. They thought they were putting money in safe bank account. That's theft, disguised as banking. By late 1988, Lincoln Savings had written $135 million in bad loans to Keating's companies. Another $300 million in risky commercial mortgages. Another $1 billion in junk bonds losing value daily. Total, $1.6 billion in bad assets. Against $2 billion total. Math doesn't work. House of cards. Collapse inevitable. But Keating kept going, kept selling bonds, kept using deposits to fund real estate speculation, kept using political connections to delay regulators. If you had pension money in funds buying S&L bonds in late 1980s, some of your retirement money probably went through this machine. Most pension managers didn't ask questions. S&L bonds seemed safe, government insured. What could go wrong? Everything. Now, let me show you exactly how Keating's money machine worked, because this wasn't just one man stealing, this was a system. Here's the flow. Step 1. Lincoln Savings takes deposits. Your neighbor's money. FDIC insured. Safe. Step 2. Lincoln invests in junk bonds and commercial real estate. High risk, high fees. Many issued by companies Keating controls or has relationships with. Step 3. Lincoln makes loans to American Continental Corporation, Keating's private company. No competitive bidding, no real collateral, just Keating lending to himself. Step 4. American Continental uses that cash to buy desert land in Arizona, build hotels, develop properties, speculative ventures that might pay off in 5, 10, 15 years, maybe. Step 5. When ventures don't pay off fast enough, Lincoln employees sell American Continental bonds to depositors, bonds backed by the same failing real estate ventures. Step 6. Cash from bond sales funds, more land purchases, more development, more speculation. Cycle continues. Money laundering. With a federally insured savings and loan as the washing machine. The lifestyle? Keating lived like royalty. Private jets. 6 jets total. Flew senators and friends to Bahamas. Bahamas Estate. Cat K. Compound with multiple homes. Keating hosted senators there. Free vacations. Deep sea fishing. All expenses paid. Phoenix Mansion. Sprawling estate. Parties for politicians. Fundraisers for campaigns. Mother Teresa donations. $15 million over the years. Built hospitals in India. Got glowing press coverage. St. Charlie, and bonuses. Keating paid himself and family members $3.4 million in 1987 alone. While Lincoln was losing hundreds of millions, but here's the psychology. Keating believed he was right. In his mind, he wasn't stealing. He was a visionary, a builder. Regulators were bureaucrats who didn't understand real estate development. Politicians were his friends, helping fight government overreach. The elderly people who lost savings? Investors. They took risks. That's capitalism. This is the narcissism of white-collar crime. Ability to reframe theft as business, fraud as innovation. Victims as willing participants. If you remember the 1980s excesses, Gordon Gekko, greed is good, lifestyles of the rich and famous, this was that era, personified. Charles Keating was untouchable, protected by senators, insulated by lawyers, funded by other people's life savings, until the math stopped working. Let's do the math on the losses. Lincoln Savings. Total assets, $5.5 billion, 1988. Actual good assets, less than $1 billion. Gap, 4. $5 billion of error, bad loans, overvalued real estate, worthless bonds, American Continental bond sales, $285 million. Real value backing those bonds, maybe $20 million in actual assets. Gap, $265 million investors would never see again. Keating's compensation, 1985 to 1989, estimated $34 million. Lincoln's actual profit those years, negative $3.4 billion. He paid himself $34 million while losing $3.4 billion of other people's money. Numbers don't lie. By November 1988, and the facade was cracking. First warning came from inside. Lincoln employees started talking. Sylvia Crowell worked as Lincoln savings bond saleswoman. Her job? Sell American Continental bonds to elderly depositors. She did it for months, then started having nightmares. She told regulators later, "I was selling bonds to people in their 80s, people who came in for certificates of deposit. Safe money. And I was switching them into junk bonds they didn't understand. I knew it was wrong." Oh, she tried raising concerns with management and got told, "Make your quota or find another job." She quit. Filed complaint with Office of Thrift Supervision. Nobody listened. Not yet. Second warning came from accountants. Arthur Young and Company, Lincoln's auditor, started finding problems they couldn't ignore in 1988. Loans to Keating companies with no collateral, real estate valued far above market, profits booked on land sales that hadn't actually closed. In October 1988, Jack Atchison, Arthur Young partner overseeing Lincoln audit, did something unusual. He quit his accounting firm and got hired by Charles Keating. $300,000 salary to do what? Help fight the regulators. Classic move. Auditor who knows all the problems switches sides, gets paid fortune to defend the very fraud he'd been examining. Arthur Young and Company later faced lawsuits, paid $400 million in settlements. One of largest accounting malpractice cases in history. Third warning came from regulators. By early 1989, patience was gone. Office of Thrift Supervision, new agency replacing Federal Home Loan Bank Board, sent examiners back to Lincoln. No more delays, no more political interference. January 1989. Examiners William Black and Michael Patriarca finally got authority to complete investigation. What they found shocked even them, and they'd been warning about this for years. Total estimated losses, $3.4 billion. More than double Lincoln's total deposits. Bad loans, $800 million. Worthless junk bonds, $1.1 billion. Overvalued real estate, $1.5 billion. If Lincoln collapsed, and it would, FDIC would pay depositors back. Taxpayers would cover $3.4 billion. Biggest S&L failure ever. The report went to Washington, January 1989. Recommendation, seize immediately, file criminal referrals. Keating knew. Felt walls closing, but still thought he was different, still believed political friends would protect him. He was wrong. By March 1989, new president in White House. George H.W. Bush, new administration. The Keating Five senators, backing away, quietly. Donations had stopped flowing, phone calls not being returned. Senator John McCain later said, "Worst mistake of my life. Meeting with regulators on Keating's behalf. I'll regret it forever." Senator John Glenn said, "I was used. Keating made me think regulators were being unfair. I should have known better. Too late, damage done." Keating had one friend left, Mother Teresa. She wrote to federal judge in 1992, pleading for leniency, called Keating kind and generous man, asked judge to show mercy. Prosecutor Paul Turley wrote back to Mother Teresa. His letter became famous. "Your Honor, Mother Teresa doesn't know about the thousands of elderly people who lost their life savings because of Mr. Keating's greed. She doesn't know about the widows who lost everything they had to live on. If she did, she'd send the money back. She never did." April 1989. Time was up. Keating had weeks left. Not years, not months. Weeks. If you were watching financial news in spring 1989, warning signs were everywhere. Delayed earnings reports, vague explanations about temporary liquidity issues, auditor departures, rising debt, classic red flags. But investors, including pension fund managers holding Lincoln bonds, ignored them. Most thought, too big to fail, government will intervene. Our money is safe. They were half right. Government did intervene. Their money wasn't safe. April 13th, 1989. 9:47 a.m. Federal regulators walked through Lincoln savings doors, not inspectors, receivers, armed with federal seizure order, signed by Office of Thrift Supervision Director, authority to take control immediately. Keating watched from his office, called his lawyers, called his senators. Nobody could stop this. By noon, Lincoln Savings and Loan was federal property. Employees sent home, doors locked, assets frozen, investigation beginning. Within 48 hours, examiners started counting losses. First count, $2 billion. 72 hours later, $2.5 billion. A week later, $3 billion. Final count, $3.4 billion. Gone. Let's do the math on damage. Direct depositor losses covered by FDIC, $2.6 billion. American Continental bondholders, $285 million lost, not covered. Estimated cost to taxpayers after asset recovery, $3.4 billion final. Perspective, more than GDP of 15 developing countries in 1989, enough to fund Social Security cost of living increases for 6 million seniors for 1 year, equal to building 300 new hospitals, one savings and loan, one man's greed, 3.4 billion taxpayer dollars. But numbers don't tell the human story. Miriam Otten, age 81, Pasadena, California, walked into Lincoln Savings Branch in 1987, wanted to renew CD, $22,000. Her entire life, savings from working as secretary for 43 years. Branch manager, woman she'd known for years, sold her American Continental bonds instead. Better interest rate, she said. Very safe. By 1989, bonds worthless. Miriam lost everything. She told reporters, I trusted them. That building had FDIC sign on door. I thought my money was safe. Now I have nothing. Miriam died in 1992, 3 years after collapse. Never recovered financially, Edwin Lowe. Age 74, Phoenix, retired machinist, bought $40,000 in American Continental bonds. His and his wife's retirement. Bonds became worthless. Edwin had to go back to work at age 74, died of heart attack 6 months later. His wife sued, got settlement, 8 cents on the dollar, $3,200. Stories like this, 23,000 of them. Average age, 68. Average loss, $12,400. For most, their life savings. But regulators found something else during seizure. Evidence, boxes of it. Internal memos showing Lincoln employees knew bonds were risky. New customers didn't understand. Sold them anyway to meet quotas. Loan documents showing Keating had borrowed $135 million from Lincoln. Never repaid. Used for personal real estate speculation. Accounting records showing Lincoln booked profits on land sales before sales closed. Booked income that never existed. Financial statements showing Lincoln valued property at 10 times actual worth. April 14th, 1989. 1 day after seizure, American Continental Corporation, Keating's parent company, filed bankruptcy. Bonds officially worthless. 23,000 bondholders became unsecured creditors. Bottom of payment list. They'd eventually recover about 10 cents on dollar. After years of bankruptcy proceedings, April 18th, 1989, 5 days after seizure, FBI raided Keating's offices, Phoenix and Los Angeles, 20 agents, carrying boxes of documents. Criminal investigation officially beginning. Keating held press conference, denied everything, called seizure government persecution, said regulators were Gestapo, blamed examiners, blamed senators for not protecting him better, blamed new administration, never mentioned the elderly people who'd lost everything. June 1989, 2 months after collapse, Congress launched investigation. The Keating Five hearings would last 2 years. Senate Ethics Committee examining whether 5 senators had improperly intervened with regulators on behalf of major donor. Television coverage, daily headlines, national scandal. The collapse of Lincoln savings became symbol of 1980s excess. Deregulation gone wrong, political corruption, greed destroying ordinary lives, and it wasn't just Lincoln. Between 1986 and 1995, 1,433 savings and loans failed nationwide. Cost to taxpayers? $160 billion. Lincoln was just the biggest, most brazen, most politically connected. Pattern same across all. Deregulation, aggressive expansion, political protection, desperation, collapse, different names, same playbook, every time. The legal reckoning came in waves. September 1990, Los Angeles, criminal trial. California prosecutors charged Charles Keating with fraud and conspiracy. 17 counts. Related to bond sales. Jury heard testimony from victims, elderly people who'd lost everything, Lincoln employees who'd been pressured to sell worthless bonds. November 1991. Verdict, guilty. All counts. Sentence, 10 years state prison. Keating looked stunned, truly believed he'd be acquitted. That jury would see him as visionary, not criminal. They saw a thief, but legal fight wasn't over. December 1992. Federal trial, Phoenix. Charges, racketeering, wire fraud, bankruptcy fraud, conspiracy. 73 counts total. Evidence overwhelming. Internal memos, loan documents, accounting records. FBI had everything. January 1993. Federal verdict, guilty. 73 of 73 counts. Additional sentence, 12 years federal prison. Consecutive to state sentence. Total, 22 years. At age 69, Charles Keating faced spending rest of life in prison. His co-conspirators, Judy Wisher, Lincoln president, convicted. 3 years. Ray Fidel, American Continental Chief Financial Officer, convicted. 2 years. Ernie Garcia, loans officer who approved fraudulent loans, pleaded guilty. Probation. But here's the twist. Keating appealed, and appellate courts found problems with convictions. 1996, state conviction overturned. Technicality about jury instructions. 1996, federal conviction overturned. Different technical issue. Keating had served 4.5 years, released pending retrial. Prosecutors offered. Deal? Plead guilty to reduced charges. Time served. No more prison. April 1999. Keating pled guilty to 4 counts of fraud. Sentence. Time already served. Freedom. He walked out. Age 75. Broken. Disgraced. But free. Many victims never saw him go back to prison. The financial cleanup. FDIC sold Lincoln's assets. Commercial properties. Land holdings. Junk bond portfolio. Recovery efforts took years. Total recovered, about $800 million against $3.4 billion in losses. Taxpayers covered the difference, $2.6 billion plus interest. If this sounds familiar, because you remember 2008 bailouts, pattern is exactly the same. People who cause crisis, dead, imprisoned, or charged. People who pay. Ordinary taxpayers who did nothing wrong. The Keating Five? Senate Ethics Committee investigated for 2 years, November 1991. Findings. Senator Alan Cranston, reprimanded for improper conduct. Strongest punishment. Didn't run for re-election in 1992. Senators DeConcini, Regal, criticized for poor judgment. Both retired next election rather than face voters. Senators McCain, Glenn, poor judgment, but no formal punishment. That's it. No criminal charges, no expulsion from Senate. McCain survived scandal, served Senate until 2018. Presidential candidate twice. Called Keating Affair, worst mistake of my life, but faced no real consequences. The system that enabled this? Congress passed Financial Institutions Reform, Recovery, and Enforcement Act, August 1989, 4 months after Lincoln collapsed. Tightened S&L regulations, created Office of Thrift Supervision with more power, increased FDIC insurance premiums, required better capital ratios, too late for Lincoln victims, too late for the 23,000 bondholders, too late for Miriam Otten and Edwin Lowe and thousands like them, but did prevent some future collapses until 2008, when cycle repeated with different institutions. Where are they now? Charles Keating died March 2014, age 90, Phoenix nursing home, largely forgotten, no apology, no restitution beyond court-ordered settlements, no acknowledgement of lives destroyed. His obituaries debated his legacy. Some called him criminal, some called him victim of overzealous regulation. The elderly people who lost savings, most died never recovering financially. The senators, most served out careers, some prospered. The system changed slightly. Until deregulation fever returned and cycle began again. So what does Lincoln Savings teach? Not just about one corrupt banker, about a system that made corruption possible, about warning signs that appeared years before collapse, about politicians who valued campaign donations over constituent protection. Lesson 1, FD. IC insurance isn't universal safety. Keating exploited this brilliantly. Lincoln was FDIC-insured. Building looked safe, had government seal on door, but bonds sold inside that building? Not insured. Elderly depositors didn't know difference, saw FDIC sign, trusted familiar tellers, assumed everything in that building was protected. Wrong. Same pattern today. Walk into your bank. They offer you mutual funds, annuities, insurance products. Same building, same employees, but not FDIC insured. If you have investments recommended by your bank, especially if you're managing retirement accounts, watch for products offered inside bank that aren't deposits, red flag number 1, higher interest rates than standard CDs. There's always a reason, red flag number 2. Pressure to move from insured deposits to better investments, red flag number 3. Fine print, mentioning subordinated debt or not FDIC insured, red flag number 4. FDIC only covers deposits. Up to $250,000 per account. Everything else? Your risk. Trust comes from understanding what you own, not where you bought it. Lesson 2. Deregulation without oversight always ends the same. Garn St. Germain. Act 1982 removed limits on S&L investments. Theory. Freedom and competition make institutions stronger. Result. 747 S&Ls failed 1986 to 1995, 160 billion taxpayer dollars. Fatal flaw. Removed restrictions but didn't increase oversight. Let institutions take enormous risks with government-insured deposits. Moral hazard. Not unique to S&Ls. 1999. Glass-Steagall repeal, separated commercial and investment banking since 1933. Repealed, 9 years later, 2008 financial crisis. 2000, Commodity Futures Modernization Act, exempted derivatives from regulation. 8 years later, collapse. 2012, jobs. Act loosened IPO requirements, led to numerous fraudulent startups reaching public markets. Pattern repeats. Politicians promise deregulation creates growth and freedom. Institutions take excessive risks with other people's money. Risks blow up. Taxpayers pay. Until conflicts of interest removed, banks gambling with government-insured money, pattern will repeat. Ordinary people pay every time. Lesson 3. Political donations buy influence. Always have. Always will. Keating gave $1.3 million to politicians 1984 to 1988. Return on investment? 5 United States senators pressuring his regulators. Years of delays. Time to sell hundreds of millions in worthless bonds. When regulators finally seized Lincoln, losses had grown from $1 billion to $3.4 billion. Because senators helped delay investigation, that extra 2 years cost taxpayers billions more. But consequences for senators? Minimal. Reprimands, criticism. Most served full careers. Tragedy. Keating Five hearings led to campaign finance reforms. McCain-Feingold Act 2002. Attempted to limit soft money. Citizens United Decision 2010. Gutted those reforms. Unlimited corporate political spending now protected speech. Today's political donations dwarf Keating's, super PACs, dark money, legal bribery on scale he never imagined. Until we acknowledge money corrupts oversight, pattern continues. This pattern isn't finished. Right now, 2025, regional banks showing stress from commercial real estate exposure. Warning signs, office building vacancies at 40-year highs. Stage 3, evidence. Banks delaying loss recognition on commercial mortgages. If pattern holds, and it always does, we'll see regional bank failures by 2026 to 2027. Watch for banks extending commercial real estate loan maturities, hiding defaults. Sudden management changes at mid-size regional banks, Federal Reserve emergency, lending to specific institutions. Historical precedent, S and L. Warning signs appeared 1984 to 1985. Collapse, 1989. Gap, 4 to 5 years. Silicon Valley Bank, warning signs late 2022. Collapse, March 2023. Gap, 6 months. Current commercial real estate. Warning signs showing since 2023. We're at year 2 of pattern. Do the math. I'm watching New York Community Bancorp and several regional banks with heavy commercial exposure. You should too. Because it will happen. Always does. Here's uncomfortable truth. System that enabled Lincoln savings hasn't fundamentally changed. Political donations still buy influence. Legal now in larger amounts. Banks still take risks with depositors' money, just in different ways. Elderly savers still get targeted with different products, same tactics, different decade, different names, same playbook. Pattern says this will happen again because incentive creating these scandals, privatized profits, socialized losses, that incentive's still in place. April 13th, 1989, 9:47 a.m. Federal regulators walk through Lincoln savings doors, boxes in hand, court orders, seizure authority. Charles Keating watched his empire dissolve in single morning. 15 years building, gone. He told himself he was different, visionary, builder, misunderstood genius fighting bureaucratic oppression. He was a thief. Behind him, 23,000 victims, mostly elderly, mostly small investors, most lost everything they'd saved from lifetime of work. Miriam Otten, Edwin Lowe, thousands like them, trusted their neighborhood savings and loan, got robbed. Keating served 4.5 years, released, died comfortable in Phoenix nursing home at 90, never apologized, never made full restitution, never acknowledged the lives destroyed. His victims? Most died broke. But here's the question nobody wants to answer. Who really paid for Charles Keating's greed? Not him. 4 years prison, walked free, kept some wealth. Not the Keating Five. Mild reprimands. Most served full careers. Not the accountants or lawyers who enabled fraud. Small fines. Moved on to other clients. Taxpayers paid. $3.4 billion. Your money. My money. Money from people who never heard of Lincoln savings. And the system that created this? Still there. Different forms, different names. Same fundamental problem. Banks taking risks with government-backed money. Politicians accepting donations from institutions they regulate. Elderly savers being targeted with products they don't understand. The next Charles Keating already exists. Building empire. Making donations, hiding losses. Different industry maybe, technology, cryptocurrency, private equity. But same pattern, same stages, same eventual collapse. I'll be tracking those commercial real estate exposure numbers at regional banks. If 3 more institutions delay loss recognition next quarter, confirm stage 4. Pattern says 2 to 3 years until we see failures. Been 36 years since Keating. System learned nothing, because it will happen. Always does.